Hello friends, in this video we are going to discuss the matching concept and the accrual concept of accounting, and we are going to discuss these two concepts in the same video because they are very related to each other. So let us first come to the matching concept. The aim of every business is to earn profit. We know the aim of every business is to earn profits, and profits are nothing but excess of incomes and revenues over expenses. And in the video of periodicity concept, we had learned that profit cannot be calculated for the full lifetime of the business. It has to be calculated on a periodical manner. Matching concept says that for calculating the profit or say losses of a particular period, the incomes of that period has to be compared with the or matched with the expenses of the same period. So the incomes of a period has to be compared with the expenses of the same period so as to arrive at the profits of the said period. And now let us come to the accrual concept. The accrual concept tells us that revenues or incomes are recorded only when they are realized or earned, and they are not recorded when they are received. So revenues or incomes are recorded only when they are realized or earned. They will not be recorded when they are actually received or the cash is actually received. Similarly, the expenses are recorded only when they are incurred, and actual payment of cash is not relevant. So expenses will also be recorded only when they are incurred, and actual payment of cash is not relevant. Now we will go through an example and discuss the matching and accrual concept within that example. Here Mr. X started business of trading in pens. Following happened in the first accounting period. He rented a shop for rupees 500 a year. So rent would be rupees 500 per year, and he bought 1000 pens for rupees 10,000. So purchase is equal to rupees 10,000 for 1000 pens. Then he bought furniture for his shop for rupees 15,000. So furniture purchased is 15,000, whose useful life, please note, the useful life of the furniture is 15 years. Next, he sold 800 pens in the first accounting period at the rate of rupees 15 per pen. So sales would be rupees 800 into 15, that is rupees 12,000 for 800 pens. And paid insurance for stock for rupees 15,000 for 3 years. He paid the insurance for 3 years. So insurance equal to 1500 for 3 years. And finally he received an advance received from Mr. Y for sale of pens. He received an advance for sale of pens to Mr. Y, rupees 5,000, but sale has not been effected yet. Pens are not sold yet. So we are required to calculate profits for the first accounting period. So let us see. Let us first calculate the profits as a lame accountant, an accountant who does not know the matching and accrual concept of accounting. So we know profits are incomes over expenses. Let us first list the incomes. So first income would be obviously the sales. So sales is we have written it, sales 800 pens is rupees 12,000. Then we have the accountant who does not know the accrual and matching concept would consider the advance received from Mr. Y also as an income. So he would record it as an income. So advance received, since cash is received, he would record this amount as an income. So advance received rupees 5,000 will also be treated as an income. So total income would be rupees 17,000. And now let us see the expenses. expenses would be rent. First expense would be rent, that is rupees 500. Then would be purchases for 1000 pens, rupees 10,000, and purchases would be 10,000, and then furniture would be, furniture was purchased for rupees 15,000, and insurance was paid for rupees 1500. So total expenses would be 15,000 plus 10,000, 25,000 plus 1500 is 26,500, and 500 is 27,000. Total expenses would be 27,000. So as per the lame accountant, the profits would be 17,000 minus 27,000 equal to negative 10,000. That means a loss of rupees 10,000. A loss of rupees 10,000. Now let us see how a learned accountant who knows the matching and accrual concept of accounting calculates the same profit. So let me do this in a different color. He will record the sales. He will record the sales at the same, because sales is rupees 12,000 only. But will the accountant who knows the accrual concept record this 5,000 as an income? Accrual concept says that income should be recorded only when they are realized. But this 5,000 is an advance received from a customer. The sales for which the advance has been received is not affected yet. So the revenue, that is the sale, has not yet been realized. Only cash is received. So since sale has not been realized, we will not record this amount as an income. Rather, this will be recorded as a liability and will find a place in the balance sheet, but it will not be considered while calculating the profits and losses. So advance received will not be considered. Advance will not be considered. So in this case, total incomes would be rupees 12,000 only. Now let us see the expenses part. For expenses, we have rent. Rent is for rupees 500 for the first year. So we are calculating the profits for the first accounting period, and let us assume that this year is the first accounting period itself. So we will consider this rent because we have already incurred this rent. So rent will be considered for rupees 500. Rupees 500. Now let us move ahead and let us record the purchases. Purchases was for 1000 pens, which was rupees, let me write it over here, rupees 10,000. But tell me one thing, these sales was for 800 pens only, and as for the matching concept, we have to match the revenues with the expenses. So was the total expense of purchase of rupees 10,000 incurred for the sale of these 800 pens? Look carefully. The total expense of purchase of rupees 10,000 was for 1000 pens and not for 800 pens. So the purchases include 200 pens extra, which was not included in the sales of the pens. So here, as per matching concept, we will have to consider the expenditure which corresponds to this income of sales of 800 pens. So for sale of 800 pens, we would consider the purchases only for 800 pens. So another way of doing that is by subtracting the closing stock. Since out of 1000 pens only 800 pens are sold, 200 pens would be in your hand, which would be the closing stock. So 200 pens would be deducted, and the value of 200 pens would be rupees 2000. Obviously, if we divide rupees 10,000 by 1000 pens, then we get the cost of the pen is rupees 10 per pen. So for 200 pens, the cost would be rupees 2000. So only purchases amounted to rupees 10,000 minus 2,000, that is rupees 8,000, will be considered as an expense of the current period as per the matching concept. Now let us move ahead. For insurance, we have paid 1500 for 3 years. So if we write rupees 1500 over here, we can see that this figure is for 3 years, but till now only 1 year has passed, or the first accounting period has passed. So as per the accrual concept, we will record expenditures only when they are incurred. So expenditure for 1 year only has incurred. However, the cash has been paid for 3 years. So the expenditure as per the accrual concepts will only be recorded for the period it is incurred. So for the first year only rupees 500 has been incurred, so we will deduct prepaid. So for the next 2 years the expenditure is actually paid in advance or is prepaid, so we will deduct prepaid insurance. We will deduct prepaid insurance of rupees 1000. That is, if 1500 is for 3 years, then it is rupees 500 a year, and we have prepaid the insurance for 2 years, that is rupees 1000. So for the current period the insurance cost would be rupees 500 only, or the expenditure in respect of insurance, the expenditure in respect of insurance for the current period would be rupees 500 only. Let us move to the next point, that was furniture. Here we see that the furniture is purchased for rupees 15,000. Let us scroll up a bit. The furniture was purchased for rupees 15,000 and the useful life was said to be 15 years. So out of the 15 years we have enjoyed the benefit for only 1 year. So allocated cost of the furniture for 1 year, or the depreciation of furniture, would be, we will not write furniture over here in expenditure, we will not write furniture over here, but we would write the depreciation of furniture. Depreciation of furniture, which would be 15,000. How to calculate the depreciation? Let us do here. 15,000 is for 15 years, so divided by 15 you get 1,000 per year. So depreciation would be rupees 1,000. So out of the total cost of furniture, that is rupees 15,000, we are allocating only rupees 1,000 for this period, and that is why we are recording it as an expense of this period. So total expenses would be 8,000 plus 1,000, that is 9,000, plus 500, 9,500 plus 500 is 10,000. So total expenditure would be rupees 10,000. Therefore profit would be 12,000 minus 10,000, that is rupees 2,000. So in this example we saw that if we follow the matching and accrual concept of accounting, then the profits are reasonable, profits can be achieved. Otherwise you will get absurd figures like we got in this case. So thus the matching and accrual concept, and accrual concept are very important concepts of accounting which needs to be followed for a correct evaluation of profits or loss for a particular period.